A day of milestones on Wall Street today. Stocks surged and the major averages hit new records thanks to a broad-based rally. All 10 of the S&P 500 sectors were up. So what happened? Well, call it the Ben Bernanke rally. Investors were inspired to buy stocks this morning following news we told you about last night, the Fed Chairman saying the central bank will continue its easy money policies. Why? Because Bernanke said the weak U.S. economy still needs help. The buying was explosive. The Dow soared 170 points, closing at 15,460. This is a new record high. The Nasdaq jumped 57 points to a 13-year high, and the S&P closed at the new record of 1675, up 22 points. Even the small-cap Russell 2000 index stands in record territory tonight. And the buying carried over to the bond market and gold. The 10-year Treasury rose with the yield down now to 2.57%. And gold prices also on the rise, up $32.50 to $1,279.
And joining us now to talk more about today's market activity and what may be ahead is Bob Dahl, Chief Equity Strategist at Nuveen Asset Management. Bob, good evening. Good to have you with us. So my question for you to kick it off is, did Bernanke really say anything yesterday that was all that different from what he's been saying for weeks? And if he didn't, what sparked the rally?
Yeah, not a whole lot different, Tyler. I think the emphasis and maybe our listening and interpretation was a little bit different. I think the world largely felt when he made his speech a couple of weeks ago that he was signaling that we're going to start going the other direction. And in fact, he was, but he kept saying if the economy is strong enough. And I think last night he said the economy clearly isn't quite strong enough, so we're there with all the guns to help.
So, Bob, who should investors be really listening to? Fed Chairman Bernanke or all of the CEOs that are parading out talking about the outlook for their businesses and their earnings over the next couple of months? Which is more important, the Fed or earnings?
It's a great question, Susie. I think we're in a transition. That is to say, the Fed's almost finished its work. That is, the PE, or the valuation improvement in the stock market, has been a wonderful thing. Pretty soon, it's going to depend on earnings, and corporate CEOs are delivering mixed messages. On the whole, positive, but not all of them and not big magnitude. So we have to watch these next earnings releases very carefully, which will be fast and furious over the next few weeks.
Do you expect that the earnings picture is going to be reasonably good as we really get into the torrent of them, beginning tomorrow with J.P. Morgan and Wells Fargo in the banking sector? And then as you look out, Bob, beyond this past quarter into the second half of this year and 2014, do you think there's going to be more earnings momentum or a continued slog?
I feel a lot better about the second half of this year and into next year in terms of earnings improvement, high single-digit earnings gains. The quarter that we're about to report could be sloppy again, particularly, Tyler, at the revenue level. Remember, revenue gains in the first quarter left something to be desired, and we may have another quarter of that sloppiness, which is part of the reason I think the stock market may back and fill before it moves substantially higher.
You know, we all get excited when we see the stock market going up and hitting new records, but the individual investor has really stayed out of the picture, as you well know, and we've been reporting a lot on it. Wondering what your take is on this Wall Street Journal op-ed piece by the CEO and founder of Schwab. The title is Why Individual Investors Are Fleeing Stocks. Are there ways to fix things so that the individual comes back in? They say that it's really important that nobody benefits if the individual investor does not participate in the markets. What do you think, Bob?
Well, Susie, we need the individual investor. There's no question about it. And in some ways, the individual investor participates in other ways, retirement plans and the like, maybe not buying, selling those stocks themselves. A lot of individuals feel that they can't compete with the muscle of the professional in the market, if you will. My view is there is some element of truth to that, but on the other hand, in the old days, it was all about who got the information the fastest. Now everybody gets the information at the same time. So if I were an individual and not, quote, a professional, I wouldn't give up, but I'd make sure I relied on financial advisors and some products that can help me get there as opposed to having to do all the work myself.
All right, Bob Dahl, always good to see you. Bob is Chief Equity Strategist at Nuveen Asset Management.